Hello, today is Thursday, July 8th, 2021. I'm Joe Schmidt from TC2, and this is Staying Connected. About 5 years ago, the two largest telcos in the U.S., AT&T and Verizon, announced with great fanfare their strategic business expansion into the world of content development. This was a big acquisition play to develop, own, and deliver content to their respective customers over their wireless and wireline networks. Verizon kicked things off with its $4 billion acquisition of AOL, quickly followed by its $5 billion acquisition of Yahoo. On the heels of those announcements, AT&T laid out much bigger plans for its future, announcing a massive $85 billion acquisition of Time Warner. This followed AT&T's very expensive $50 billion acquisition of DirecTV just a year or two earlier. But here we are in 2021, and both companies have taken a huge U-turn and announced that they are unloading all of these acquired assets at fire sale prices, resulting in huge losses all around. This M&A behavior is a head-scratcher for sure. To help make sense of it all, I'm joined by Andrew Brown, the managing partner at LB3 and chairman of TC2, and to be honest, one of my favorite Staying Connected guests. Hey, Andrew, welcome back to the podcast.
Thanks, Joe.
So, Andrew, I'm not even sure where to start with this. What the heck happened here?
I think there are a few straightforward explanations, but it is pretty amazing how quickly both companies unwound these big mergers and really just did an about-face on kind of similar business strategies they look to be betting on to drive their growth for the next decade.
So why don't we start with AT&T? They spent years getting the Time Warner merger completed. They had to fight off and win an antitrust suit brought by the government to block it, then basically announced a few months ago that they were just walking away from it.
Yeah, well, the prior CEO of AT&T had this idea that AT&T needed to own and develop the content that it was delivering over its network to its customers. That's how they were going to really compete with other tech companies in the coming decade. And everyone kind of knew that it was a moonshot sort of thing because the content business is incredibly expensive, super risky, and most importantly, it's totally different from running a telecom network. There have been a ton of companies that bought movie studios and failed at the business miserably, whether it was Coca-Cola buying Columbia Pictures or Gulf Western owning Paramount Pictures. It seems like it always ends badly.
But AT&T was going to be different. It's amazing that they still got this financed and spent so much time and money getting this through the regulators.
Yeah, I know. It seems like there literally is no acquisition that Wall Street won't finance for AT&T, no matter how ill-conceived it is. AT&T has always done these really, really big, supposedly game-changing acquisitions, and they rarely work out well, strategically or financially. I mean, remember when they bought NCR in the 90s to become a player in the computer industry and dumped it 5 years later at about half of what they paid for it? And then they planned to become a huge cable company in the 2000s and bought TCI and Media One before having to dump those onto Comcast, also at a huge loss.
That's quite similar to what has transpired here.
Yeah, it is. So they bought Time Warner for like $80 billion. But had assumed debt of at least another 20 or 25 billion. And this comes right after they finished acquiring DirecTV, which you mentioned earlier. So their debt load was just huge, just like it was back in the early 2000s after they went on their cable buying binge, something like $120 billion or more in debt. So unless AT&T could generate some serious cash flow off of their investments very quickly, it was going to be a huge drag on their profitability.
So what happened?
Well, AT&T didn't generate serious cash flow off their investments quickly. Look, AT&T spent almost 2 years in court fighting an antitrust suit brought by the Trump administration, which many people considered one of the stupidest and worst antitrust cases ever brought by the government against a proposed merger. And so AT&T won that case and they were able to proceed with the merger, but the lawsuit delayed the merger significantly. And it really cost AT&T a lot of time and money in terms of executing on their strategic plan. And then once they did get started, turns out there's a ton of culture clash between the AT&T telecom side and the Time Warner creative side. So that consumed a ton of energy and focus.
It's amazing because that sounds Exactly like what occurred when AOL bought Time Warner back in 2000. Big culture clashes and finding out there's really not a lot of synergy in combining content and networks.
Yeah, no kidding. And the AOL Time Warner merger is considered to have been one of the worst and most expensive mergers ever. So you'd think there was a lesson to be learned by maybe looking at that first before going down this road.
And so history repeats itself. So why did AT&T decide to unwind it?
Well, a couple of reasons. First of all, investors hated the deal. AT&T stock was way down. It had lost something like 30 to 40% of its value post-merger. And this is at a time when the overall stock market is rallying like crazy. So that's not really sustainable, especially when you're a company like AT&T that cares so deeply about its stock value. I mean, it's still kind of treated like a utility stock that everyone's grandmother can own. And then there was the debt load we mentioned earlier, which was having a real and immediate impact on the company's ability to invest in its networks. AT&T is facing some huge capital expenses to upgrade its wireless network to make it 5G ready. It just had to spend $22 billion at a recent spectrum auction to get C-band licenses that it needs for 5G, and it still has billions more that it has to invest. So AT&T needed to clean up the balance sheet, and they needed cash, and they needed to do all that quickly. And lastly, the new AT&T CEO didn't really want to run the kind of company that his predecessor envisioned. He has a different vision for AT&T, focused more on being just a network provider and doing what they really know how to do from a financial, technical, sales, and frankly, cultural perspective.
And let's not forget that Verizon made its own journey down this path, but it looked a little different, right?
Yeah, it did. Verizon's strategy was a lot more modest in scope, but it was also kind of curious. I mean, when they bought AOL, a lot of people were scratching their heads, kind of not even sure that AOL was still around anymore.
Same thing with Yahoo. It was an iconic platform in the late 90s, early 2000s, but seems like it's been replaced mostly, well, almost entirely by the likes of Google and Microsoft.
Exactly. But apparently, and you can call this one of those things you never knew, AOL had one of the best mobile ad revenue platforms, and Yahoo still had some astonishingly large number of subscribers and eyeballs that regularly consumed their content. So Verizon's plan was to acquire those assets and really use them to increase revenue on the wireless side by monetizing the content that went over their networks. And I guess this was going to somehow make them competitive with Google for online ad revenue.
But clearly that didn't work out.
Nah, not really. I mean, they had some of the same familiar problems dealing with corporate integration of content-focused entities and with what is basically still just a telco. I mean, Verizon created this new division that contained Yahoo and AOL that they called Oath, which no one really understood what that even meant. And then they renamed it Verizon Media, which is kind of what you'd expect a boring telco to call their content division. And ultimately, they just decided probably correctly that this was a bad idea, and they sold off their $10 billion investment for $5 billion to an investment group. So a big loss for sure, but nothing like the hit AT&T took.
It's interesting that both companies pulled the plug on these investments at about the same time to refocus on their core network services, particularly 5G. I think that's ultimately going to be good for the enterprise customer.
Yeah, I agree completely. These mergers and content plays really didn't offer anything to enterprise customers. No real technical innovation on the network side, which is what we really care about, and really did create the potential to drain some strategic focus and capital investment away from core network services. So the more these companies focus on what we care about, the better overall it's going to be for enterprises.
Well, and as we know, Andrew, while all this was going on, T-Mobile was flying under the radar, integrating the Sprint side of the business, building out its network, and piling on the subscribers. I think they were pitching themselves as the uncarrier, while it appears that AT&T and Verizon were basically mastering the unmerger.
It's a very clever turn of phrase there. But it's true. Because T-Mo really is in a good position in all of those areas, they've started to make a renewed effort to sell into the enterprise space where they've never had much of a presence. I mean, you remember that really up until the mid to late 2000s, Sprint was a real third competitor in the enterprise wireless and wireline space. And they just fell out of the market almost completely. So T-Mo is kind of taking a strategic step to try to rebuild that presence, at least on the wireless side. And, they have a long way to go, but there's some promise there.
And that would seem to create some opportunities for enterprises to introduce some real competition into their wireless service procurements.
Absolutely. And we love any kind of competitive leverage wherever we can find it.
Yes, we do. Okay, thanks, Andrew. This has been fun and informative as always. Now, if you would like to learn more about the goings-on at AT&T and Verizon, or perhaps with some other vendors, and trust me, there's a lot happening in this industry, please contact Andrew, me, or any of our colleagues at LB3 and TC2 by giving us a call or dropping us an email. You can also stay up to date by subscribing to these Staying Connected podcasts, checking out our websites, and by following us on LinkedIn.